Hi guys, this is Terry with Futures.io. It is my honor to welcome back Brannigan Barrett for today's webinar on trade strategies using market profiling and price action. If you have questions, you can type them into the questions box and we'll do our best to answer them at the end of the event. If you're watching us on YouTube, please do us a favor and give us a thumbs up if you enjoy the webinar. Also, please feel free to share, comment, subscribe to our channel. It really helps us a lot. Also, don't forget that you can now follow us on Facebook and Twitter at Futures.io. I would like to direct your attention to our current webinar schedule. You can view the schedule on our homepage at www.futures.io. And if you have any ideas for webinars, please post and let us know. Without further delay, I'll hand it over to Brannigan.
Good evening, Terry, and thank you very much for the introduction. And good evening, guys. And it's brilliant to be back here. I had a lot of fun doing this the last time, and hopefully I can share one or two things with you guys tonight, and you know that you can really gain something from this. So the title of tonight, let's go back there. Sorry, the title of tonight is The Art of Trading with Objective Tools. Now, I'm going to start off with obviously Rudyard Kipling's poem, and it's basically if you can keep your head when all about you're losing theirs and blaming it on you. If you can trust yourself when all men doubt you but make allowance for their doubting too. If you can wait and not be tired waiting, you will become a trader, my son. Now, that last part I've added in, just to kind of sort of bring it in line with what we're going to do tonight. But, this is the crux of what trading is about now. It's about, being that little bit different, that having that edge on all of your competition out there. So what we're going to talk about tonight in summary is an introduction to market profiling and price action trading strategy. So that's pretty much it. Let's go through the schedule. Now, what we're going to do is we're going to start off with market profiling as a tool. We're then going to talk about price action as a trading tool. Part 3, we're going to look at how to design. that edge through using things like market profiling and price action. I'm then going to explain a template for you. This template is going to show you how to set up a new trade strategy and utilize that. Please guys, that template is for you to develop your own trade strategies. And then I'm going to empower you. Tonight, I want to empower you. I want to challenge every single one of you listening to this to become a better trader. And being a better trader isn't about making more money. Okay? Every single day, I'm surrounded by traders. We lose, we win, we lose, we win. And that's irrelevant. What's important is that we can work on certain things. And some of those things you need to sort of take away from this is that you become more consistent, you're becoming more efficient, and ultimately you become more profitable. So those are our objectives. Without further ado, let's get straight into it. So first things first, about the author, about me. For those of you who don't know me, that obviously a few of you will know me because we've been talking for quite a number of years now. I'm a proprietary futures day trader. I trade every single day, Monday to Friday. If I could, I'd probably trade on Saturdays and Sundays as well. So instead, what I do is I prep on Sundays. I am an outright trader. I do like spreads. I do look at equities. I look at a lot of different things, but I'm an outright day trader. In terms of sort of financial experience, well, I've been in the financial markets for 8 years. 5 of those, as of today, actually, is my 5-year anniversary as an outright prop trader. In terms of markets, I trade predominantly the euro dollar, the cable, as well as German Bund, US 10-year gold, WTI oil, the E-mini 500, and the Eurostoxx 50. Now, a lot of you might say that's a lot, a lot of you might say it's a little. The important thing and the reason why I trade these sort of 8 markets is because that gives me a very good global macro type view, because I'm trading a dollar, a commodity, a bond, and an equity. So I tend to be able to pick up on strong correlations across the markets. In terms of my main market tools, it's market profiling, price action, and candlestick formations. That's what I use day in, day out to develop my strategies and develop my edge. In terms of time frame, again, a question I get asked so often. Sometimes there's a time frame of about 1 second, guys. If I can take that next price increment out of the market, I'm going to do it. Why? Because trading is not about the trades you do. Trading is about, making winning trades. That's what it's about. So it could be a 1-minute trade, and sometimes I'll hold on to a trade for days or weeks. Some of you that follow me on Twitter would have known how strong I was about the Nintendo long, and I had to sit in that for 3-4 weeks. It was painful, but eventually I got paid. So it all depends on what I'm trying to achieve as to the time frame I'm using. All right, so that's about me. Let's get into it now. The important thing before we go forward, and I did a little YouTube video on this, so if you ever want to go and watch an interesting video, type in YouTube, why 95% of traders lose money. It's very simple, guys, okay? 95% of traders fail because they all have common traits. They all have common characteristics that define them, that put them in that group of, call it failure, all right? And these are now, again, I've been sort of mentoring for a long, long time, and I pick up on these, these mistakes all the time. So one is overtrading, okay? Again, I don't want to say that there's no hard, fast rules to what's overtrading, what's undertrading, but the important thing about overtrading is the minute you're taking trades that don't make sense or that don't align with your edge, you're overtrading, okay? The second one is no defined edge. Right, so many traders, they'll start off good, they'll have a trade strategy that they follow, and then all of a sudden they get sidetracked by a friend, by CNBC or something like that, and then they lose their edge and eventually blow out. Emotional decision making, okay, we've all been there. I think I was making emotional decisions the last 2 days in the bond markets, okay, so again, emotional decision making is a very strong characteristic for 95% of people that fail. A lot of traders that fail, they guess a lot. Okay, they use what they like to call the intuition, and they trade a lot more subjectively rather than objective. And we're going to talk a lot about this theme tonight. In terms of egos, okay, we've all got egos. We all do ego trades. Again, egos are a big reason why a lot of people fail. Not enough time spent on interpretation, and this is a key one. Okay, there's too many of you out there that look at, for instance, we get a pin bar candle, and the entire universe knows what a pin bar candle means, and we all execute the same way. So we all see this, the strong pin bar, and we execute the same way, and then it doesn't work, and we never actually go back and try and sort of extrapolate, why did this not go right? What led this trade setup to not work in this instance, but it worked in that instance? And that's what I mean by not enough time spent on interpretation. We don't, delve enough or deep enough into, the whys and ifs and hows. We fight trends, okay? A common thing. I often see people going, when the dollar was trucking last year, or the oil was, dropping for the early part of this year, everyone's saying, where's the low? It's oversold, or, it's going to bounce. Of course it's going to bounce. But until that trend stops, we don't fight trends. Okay, another big one, and we've all been here, we take big losses, guys. Remember, big drawdowns is what kills particularly new traders in their careers. And then probably the crux of it is complete dependence on tools for confirmation when markets are forward pricing. What do I mean by that? In other words, there's too many out there of you, and think about what I'm saying here. There's too many of you that rely on your charts to make your decisions. Okay, you see a candle formation or you see a pattern, and you straight away you go, well, I'm going to go long, I'm going to ignore everything else, and all I'm going to do is execute on my ABC equals D. And again, guys, unfortunately, we are in the day and age now where trading has become so competitive that, lagging tools like moving averages and stochastics and all these things, they're so automated now that the edge, of course, they still work sometimes, but the edge is sort of being grinded down so much now that, that trade almost, it works a lot less than what most people think. So the crux of this, guys, to be successful, you have to avoid what 95% of people do. It's simple. It is as simple as that. You want to be successful, you want to be that 5%, you got to go contrarian. You have to do what every one of these people do. You have to do the opposite. You have to take small losses. You have to go with the trend. You have to be very objective. No emotional decisions. You have to have a defined edge. You must undertrade and be patient. Those are the kind of things you need to do to be a part of the 5%. Okay, so let's just move on. There's no certainty in trading, guys, only probabilities. All right. Price action, very key. It's objective, and we're going to talk a lot about this. What I mean by that, it's fact. Okay, if a buyer steps in and he starts buying up the market, that's a fact. Okay, so if I'm going to start selling it to him because I think there's a level or a resistance, what am I doing? Well, I'm being subjective when objectivity is telling me to stop being subjective. Okay, so price action is forward-looking and it's real-time data. Market profiling is a holistic, objective, factual, context-based understanding of market activity. Okay, so again, what am I saying here? In other words, the mistakes a lot of new traders make, we can avoid by using both price action and market profiling. Why? Because they're objective, they're forward-looking, not based on lagging information. Okay, so the key, gaining an advantage over your competitor, that's what this is about, guys. I'm going to give you a few ideas how you can gain real edge. Okay, I'm not going to give you the Holy Grail because unfortunately that doesn't exist. Not tonight. Maybe tomorrow, but not tonight. Tonight I'm going to give you an idea how you can develop your own edge. Alright, what is market profiling? Let's move on. It's simple, guys. Market profiling is a chart. It's a graph that depicts price, time, and volume in one chart. So what do we have here? Very simple. We've got a whole bunch of crazy letters. Letters of the alphabet. Okay? Each one of those letters depicts a half-an-hour auction process. Right? On the right you can see we have the price of the market. Right? And then what you can see is you can see a low here, so that's the lower bound of the range of the day, that's the higher bound of the range of the day. In the middle we have different color letters. Now that depicts where 70% of all volume has been traded over a period of the day. Okay? On the right here we can see how volume has been dispersed over a number of prices. The red line here is what we would consider the volume point of control. So it's the price that the highest amount of volume traded over. We then have this little red star, which is the closing price of the market. We have the O, which is the opening price of the market. We have this crazy little cool circle in the middle there. That's the 50% of the range of the day. So this entire graph can effectively show me a lot of information all in one pattern. Now, don't worry too much if you didn't understand all of that I threw at you. Market profiling is a very in-depth market tool. Okay, the objective of this is not for me to teach you market profiling. I want to give you some thoughts. Okay, now, market profiling, the core idea is simple. Okay, all financial markets are measurable by time, price, and volume. Now note, not all prices are equal. Okay, so traditional trading, if you're looking at candlesticks, every single price on a candlestick is treated as an equal. Okay, however, that is not the case in trading. Why? Because volume, or the interaction between buyers and sellers, differs at every single price. Okay, so that's like for me, instance, for saying there's a bag of oranges that are going, and there's a whole bunch of oranges being sold, and their starting price at $2 because they're trying to get rid of them. Now, there's going to be a lot of activity when the price is $2, all right, as opposed to when the price is, say, $5. Now, we cannot therefore say that $2 is as significant as, say, $5. Okay, there's a very big difference there, and the difference comes in the way buyers and sellers interact with one another, and it's that interaction that gives us an edge. Okay, now, as we said, therefore all opportunities are not equal, which is key in managing probabilities of risk. In other words, if there's a higher probability of success because we have noted something, right, that reduces our risk. All right, now, market-generated information is pure, unbiased information that comes direct off. In other words, we spoke when we said profiling, price action are both objective tools, right? And in other words, there are unbiased information. It's not information we're making up, it's fact coming from the market. It's the market telling us one thing. All right, now, structuring and interpreting this information is an excellent way to get a truly objective opinion about what's driving the market movement, and it's based on real order flow. Okay, again, note, it's forward-looking. Market profiling is forward-looking. It's not lagging information. We're not talking about moving averages, support and resistance, trend lines. Okay, those are all lagging information. It's old information that we lean on as reference. Okay, market profiling is about identifying opportunities where the risk is considerably less than the potential reward. And again, guys, I'm going to show you what this looks like when we get to a few slides later. So let's move on. The auction process. It's very simple. This is what profiling is about. It's an auction. All right. Back in the day, you'd have the pits, you'd have the buyers and the sellers all surrounded by each other, and then the buyers would bid and the sellers would offer, and that was an auction process. And price moved based on how these buyers and sellers were interacting. Market profiling is that exact auction, except it's now depicted in a chart. Okay, so auctions are made up of three fundamental elements, and we spoke and we said they are price, time, and volume. Now note, price is an advertising opportunity. In other words, if there's a low price, it's advertising one thing. If there's a very high price, it's advertising another thing, which is a discount and a premium. Okay, time regulates each opportunity, and it's very important to understand this, because if we have an expectation that there's plenty of buyers, there's a very aggressive discount in the market and the price is showing it, then we would expect a very short time in which buyers would engage at that price. Right? Whereas if we were, say, closer to a fair value, right, then we would expect maybe a much slower time for buyers and sellers to interact. Right. And then volume measures the degree of success of each auction. Now, fair value is price levels that are attracting the greatest volume of trade. So in other words, fair value is nothing other than where buyers and sellers are in the highest agreement of price. Okay? Now, identifying fair value is pivotal, guys. It is crucial in understanding the forces within the market. And more importantly, identifying fair value is crucial if you want to learn the art of the auction process. Okay, so volume, so key, guys. Volume determines whether or not divergences from value can be sustained. All right, some days buyers and sellers can be discouraged from moving away from fair value, and then you get mean reversion. Okay, you've often seen that strategy where the market has been consolidating all day and then suddenly it moves outside of the top end of the range or the bottom end of the range and suddenly snaps back. Why? Because there's not enough volume, or there's not enough interaction or engagement from either the buyers or the sellers to move price away from fair value. On other days, we see price move quite easily and quite aggressively away from fair value, and it attracts a high interest from buyers and sellers in the form of volume. Okay, now, objective of market profiling, the objective of a market, guys, and most people don't understand this, but the main objective of a market is to facilitate trade. Okay, if you go back into history and you look at marketplaces or, where the farmers came and they sold the cattle, the whole objective of a market is to facilitate trade between buyers and sellers. So the question you have to ask yourself is the market doing a good or a bad job at these prices? Okay, so if there is high amount of volume, a high amount of interest over a certain number of prices, then the market's doing a very good job of auctioning. Why? Because it's bringing buyers and sellers together to interact with one another. It's when the market moves away or in one direction on low volume, okay, that it's not attracting or not facilitating trade in the most efficient way. Now, I'm not saying that prices can't keep going up and up and up in low volume. Of course they can, right? But the important thing is that divergence away from, the principle of facilitation of trade will eventually snap back and mean revert. Okay, now, the basic auction process is very simple. Yeah, we have the wonderful Mona Lisa. And if any of you have seen her in the Louvre in Paris, she's actually a lot smaller than what you think. I always kind of remembered her being beautiful in the pictures, but she's very small in real life. Now, what I would say to you is this is what an auction looks like, guys. Now, if you really want to see, how this works, I'd advise you go look on YouTube and have a look at how these auctions work. But it's very simple. Imagine you're in an art auction and the Mona Lisa's up for grabs. Now, the auctioneer comes out and he starts at 1 million. Now, each one of these dots depicts time. So it depicts the amount of time between when the auctioneer changes the bid. Okay, because he's getting a hand up. Now, the important thing to understand is we can see that we go from 1 million to 2 million. We suddenly go from 2 million to 4 million, so we get a little bit of skipping there. Suddenly from 4 million to 6 million, suddenly 6 million to 10 million. So note the aggression, guys. Note how aggressively the market's auctioning from 1 million to 10 million straight away. So what does that tell us? Bang, discount. Okay, a lot of people perceive that 1 million, 2 million, 4 million is discount for the Mona Lisa. Suddenly we can see from 10 million, the increment changes. It goes to 10.5 million. A little bit more time spent in the auction. And then suddenly we move from 10.5 to 11. Okay, so note how the increments have changed. And then from 11 we move to 11.25. And more time, 11.25, 11.25, 11.25. Who wants it, guys? Who wants it? Okay. Do I hear 11.5? Does anyone want 11.5? Okay. Where's my buyer, Sada? Who wants this? Come, guys. All right. The minute that auction starts to stall and slow, we're starting to come closer to fair value. Okay, so the important thing to understand in any auction process, it doesn't matter whether it's art, it doesn't matter if it's, you're going to the local market for some fruit, it doesn't matter if it's the marketplace. The most important thing to understand in any auction is the type of bid, in other words, 1 to 2 to 4 to 6 to 10, the speed, 1, 2, 4, 6, 10, 10.5, 11, the participation, how many people are engaging. You're going to see a lot more engagement, as we saw, at lower prices than we started to see at higher prices. And then the more important is the price acceptance. So how does the market accept this price? Okay, where it accepts price, that is where we're starting to get towards fair value. And sold at $11.5 million. Okay, that's the auction process. Now, what we're going to move to, and this is the pertinent question, is why do professional traders use profiling? Okay, what is so key about profiling that we spend a lot of dollars obtaining the software? Well, it's very simple. Okay, one, it's a tool that we can recognize consistent patterns. So I can go every single day, I can look across my profiles and ensure I'm recognizing any potential patterns from the market. Two, it's a tool for interpretation. Okay, so instead of me going, well, this candle means that, okay, it's going to allow me to think about the market. It's going to allow me to try and understand the market and the forces behind the market. So it's the old give a man a fish or teach a man to fish. Right now, again, most of you are wanting me to give you a fish, but I'd rather teach you to fish. All right, then it's objective rather than subjective. Principles rather than hard, fast rules. So it's dynamic. Now note, with the birth of algorithms, right, you have to, as a day trader, become dynamic. Right? If you're not dynamic, you will not survive with the birth of algorithms. Right? It's an obvious application, right, exact risk, and it's not wholly automated. In other words, you can develop an edge. Right? It allows us for exact money management. Note, if I get in at X, it should not be doing Y. If it does Y, I exit. So it's exact money management. And most important, pro traders all around the world are using profiling. All right, so it becomes self-fulfilling. So let's move on to objective versus subjective. It's simple, guys. Subjective, influenced, feelings, opinions, intuitive, instinctive. If you feel any of those over the course of the day, write it down. Write down I'm being subjective. Okay, some of the subjectiveness comes from things like fundamentals. Bang, Brexit. Okay, Brexit. The UK is in big trouble. They're never going to get a trade agreement. Pound must go to parity because this guy on Bloomberg and CNBC said it, and David Cameron's gone, and so we create suddenly the subjective idea about what we're hearing, and based on some of the fundamentals and the data we receive, some of the opinions we receive, and then we form that. I think the cable must go down. I think if Donald Trump wins, the dollar is going to weaken. I think is dangerous. I think doesn't pay the bills. I think will not put money in your bank account. Objective, not influenced, factual, unbiased, neutral, fair-minded, open-minded, impersonal, and unemotional, guys. All of those words should sound hard. They should sound, real to you, because that's what trading is. It's objective analysis. We trade what we see, not what we think, not what we want the market to do. All right, and that's where market profiling, price action, and trade strategies comes in. They allow us to remain objective. So it's like the old guy sitting with his wonderful wife. She baked her first cake, and he's looking. He's like, no thanks. Rather than try it, I'm just going to form my opinion. You can't cook, and I'm not going to try it. All right. Whereas objective, we can see is factual. There's 4 of them. We don't need to argue about that. There's 4 of them. Now, write this down somewhere. Are you being objective? Is this trade objective? Is my strategy exact? Write that down, stick it on your PC, and make sure every time you take a trade, every time you're thinking of taking a trade, every time you hear CNBC say take a trade, write that down. Are you being objective? Is this trade objective? And is my strategy exact? If it is, you're on the path to success. Now, objective versus subjective analysis. I'm going to give you 1 minute. I'm going to go quiet. Read through those examples and tell me in every one of those, where is it subjective, where is it objective? And we'll come back in a minute. Hey guys, I'm back. Alright, let's go through this. So straight away, US non-farm payrolls, the biggest data piece out of the US, comes out once a month, first Friday of the month. Bang, hits the screens, 300,000 versus 180 expected. The markets go wild. Alright, now, we all know, good number. You know, US dollar should rally. Why? Because the Fed wants to hike, blah, 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 blah. The US dollar should rally 1 to 2% given how strong the data is. Straight away, you've got to look at it and say, why should it rally? Okay, bang, subjective. We're not being objective, we're being subjective there. We think it should rally. Okay. Number 2, US non-farm payrolls, 300 versus 180. The US dollar could initially see buyers enter given stronger than expected data. Bang. Now we're being objective. Now we're looking at the market holistically. Not giving our opinion, right? But we could initially see buyers. So if we see them, we interact. Not we're going to. If we see buyers, we interact. US non-farms, 300 versus 180. The dollar could see buyers enter with high probability for a trend-like move. However, buyers are unable to sustain a strong bid. This implies strong sellers are using the liquidity to execute large orders. Now, this is a tricky one. It's a conundrum, right? There's a little bit of subjectivity in there in that we assume if large buyers cannot move the market higher, that sellers are absorbing and using the liquidity. Therefore, there's a little bit of subjectivity in there. However, there's also a little bit of objectivity in there. Okay, why? Because we're noting the buyers. We're noting the big buyer lifting the market, buying it up and not being able to. Okay. Then, by the way, guys, there's no right and wrong here. Don't feel like it's right and wrong. I just want you to get the basic crux of it. The E-mini 500 gaps low. Why? Because aggressive overnight selling because of Brexit. The market can bounce because it's oversold. Can it? Might not. Okay? Subjective. The E-mini is gap low because, again, Brexit. There's a high probability for gap and continuation. Now we're being objective, okay? We've gapped, and we know gap rules are that there could be a continuation if we cannot fill the gap. Now we're being objective. We're not being subjective, we're being objective. The E-mini, again, gaps because of Brexit fears. If the market trades to my key support, I will buy it for a bounce. Okay, again, if it trades to my key support. So what I define as key support is what? It is subjective. However, I'm using an objective approach. In other words, I've got this line in the sand. I'm going to buy it because I feel it's support, but I've got risk in place. So again, we've got a mix of subjective versus objective. Now note, guys, what I'm trying to get across here is that it's okay to be subjective. You need to be objective. You need to be intuitive. However, you want to base your decisions on a combination of objectivity first and foremost and a little bit of subjectivity. Okay, again, oil is sold off. Why? Because Goldman Sachs says there's a possible correction likely. Right? They say we see a big correction coming. If I see a buying tail on the 60-minute candlestick, I will buy with Goldman's comment. Bang. What are we being here? It's a trick. Okay, we're not being subjective. We're not taking Goldman's advice. We are waiting for a 60-minute candle with a buying tail. Bang. We're as objective as can be. Goldman might be wrong, they might be right. But we are using objectivity to take part in this idea. Again, if I see low volume extension on the current day's lows of the oil, I'm going to fade it with a $1 stop given how important Goldman Sachs' opinion is. Again, I'm being objective in my approach because I've just said, okay, I'm going to fade it if I see a failed extension of today's lows and I'm putting a risk parameter in place. Okay, I'm not sitting there going, well, Goldman Sachs says it's going to go up, so I'm going to buy it, and I'll just stop out when my account gets to zero. Okay, so again, we're being objective with a little bit of subjectivity. And then the last one, I'm going to get long and look to average myself into the position, given I agree it's definitely oversold after moving 15% down in 3 days. Now that is as subjective as can be. Okay, there's no such thing as oversold, guys. Please remember that. There is no such thing as oversold. A market will stop selling off when the sellers decide to stop selling it and the buyers start buying it. Okay, brilliant. Let's move on. Now, basic market profile examples. I'm going to go through this nice and quickly. Okay, again, guys, if you don't understand the profiling, that's not too important. The crux of this is the power of the tools and then the practical example. So we've got 3 basic elements in profiling. One is called a tail. We get 2 types, a basic tail, a hidden tail. Now, as you can see, all a basic tail is the market can only create one letter within, or one letter, and then very quickly auction away from this. So we can see how quickly the market moved away from this series of prices. Okay, and it decided to auction prices up here. Now, these tails are quite powerful. Why? Because it shows us that the buyer was in control. A hidden tail is nothing more than a tail. However, it's hidden because we can't see it unless we open up the profile. So we can see in this example, we can see how there was a little bit of a hidden selling tail, not once, but twice. So we can see that sellers were engaging at higher prices and buyers were backing off at higher prices. So these hidden tails can sometimes be equally powerful. Then we have a high volume area and a low volume area. Now, a high volume area shows us, note, where there's a large amount of two-way trade, so a lot of interaction between buyers and sellers. Now, markets tend to spend most of the time creating high volume areas, okay, so buyers and sellers interacting. Now, what's an example? There's an example of a high volume area or a high volume area. Then we have a low volume area, which is this area here. Now, it looks a little bit similar to a tail. The concept is similar to a tail in that the market moves very quickly away from a series of prices. So imagine this. All morning the market said, well, we like accepting this price. We're going to trade between 50s and 90s. And then suddenly the sellers say, bang, some fundamentals have come out, or there's a technical break, and we're going to initiate some very aggressive shorts. And the market quickly moves away because sellers feel that the price was at a premium based on whatever they make the decisions on. The market then moves and starts to accept value low. Now, that low volume area shows us initiative from sellers. In other words, it shows us that the sellers were in control and will remain in control so long as that low volume area remains intact. Okay, so those are 3 principles. Tails, low volume areas, high volume areas. Tails show us initiative, low volume areas show us initiative, high volume areas show us acceptance. Okay, let's move on. Now, here's an objective versus subjective analysis with a trading example. So, most of you will use these wonderful things called lagging indicators. Now, this is the E-money S&P as of 3 days ago. Now, a lot of you should have been trading it because it's moving. Now, I want to show you how painful it can be to sometimes be subjective rather than objective. Now, no, we had this wonderful big red candle over here, right? It came on the back of big selling. We can see obviously volume picked up quite aggressively. We can see a lot of range expansion. We can see the break of key support. Okay, we can see the break of maybe a trend line. We can see the break in acceptance below the 50-day moving average. Right, so we've got a lot of lagging indicators that are suggesting that trend should continue. Now, a lot of you came in and you saw it all over Twitter, and even CNBC was barking on about it being the beginning of a crash or a collapse or a blah, 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 blah. Now, the important thing to understand is that all of that information that we received after that day before that wonderful green candle was lagging information. Okay, so why I'm showing you this is because most people came in, most traders came in the next day with the idea of looking for short side trades. So straight away they went into subjective mode. They forgot to remain objective. And I can tell you right now that 9 out of 10 day traders would have lost money in this market on that day. And if you did make money, okay, I would like to know what trades you did. But most traders would have lost money. Why? Because, not because we're bad traders, but because we became subjective instead of objective. Okay, now the leading indicators, like I said to you, price action and market profiling. Now I'm going to show you what objectivity looked like the next day. So on this green candle, let's have a look now at these profiles, and I'll show you how all of a sudden, had you remained objective on the day, you would have done quite well. Okay, so here's the example with the blue circles. As we can see, the market opened up down here, and straight away, what do we get? Bang, a tail, a buying tail. Now remember what I said to you, buying tails show initiation. So straight away you've got to say to yourself, well, heck, if I'm expecting sellers to dominate this trading session, why the hell are buyers starting off so aggressively? So there was a very early clue that something was just not quite right. So had we remained objective, there was an early objective clue. The market then accepted a bit of value. So we started to accept value where? In the lower bounds of the previous day session. So at this point, you could argue that the market's still neutrally bearish. So we can still look for short side trades. Why? Because we can see that sellers and buyers are engaging within the lower bounds of the previous day's range. However, we then got a very aggressive, low volume area initiation from buyers. So straight away, guys, you've got to say to yourself, well, if I had the expectation that there was going to be bearish and sellers all day long because of the previous day, well, heck, the market was not showing that sort of objectivity. It was not showing fact-based information using a simple tool like market profiling. And that's the crux of it, guys. That's the key to that. All right? If we had remained objective, if we had ignored the previous day completely and just traded what we saw on the day, we would have done okay. We would have made good money. Now again, note the hidden tail. So I just want to show you these red lines on the Z print show you how we opened here and we closed here. We opened on the A print and closed somewhere up here. So again, we were filled, the market was filled with these basic little tools or these basic clues using market profiling. Right? So had we used that profiling as our desired tool, we would have been objective and we would have been okay. Now, someone says this to me, Simon Cole sits behind me every day, and he says, market profiling keeps us honest, and it does. Time and time again, I put my own subjective opinion in the market, and time again, market profiling says to me, be honest, stop being delusional, stop thinking you can be subjective. You need to be objective first and foremost with a little bit of subjectivity. Okay, so let's move on. Trading with price action. Now, we've dealt with the first part of our section. Now we're going to move on to price action. Okay, it's very simple. I'm going to go through this quite quickly, guys. A lot of you know what this is. It's a ladder, depth of market, right? Some people call it order book. Some people call it depth of market, market depth, right? This is a price ladder. It depicts the auction. So it shows price in the middle. It shows buyers or bids on the left at every price, and it shows offers at every price. Okay, let's move on. So what is a price ladder? Well, it's very simple. Okay, it's the auction process, just instead of people shouting at each other with hand signals, it's effectively just showing us the buying and selling at every single price. Now, the important thing to note, like I said to you, two things. One is the 6 here. That shows us the actual physical trade at each price. So in other words, if there's a 6 there, it means that the market has traded 6 lots or 6 contracts at 30.69. These bars on the right are very important. Why? Because they tell us the actual volume traded at each price. Remember what I said to you in the beginning. Not every price is equal. Candlesticks and most charting software treats every price as equal, but they're not. Remember what I said to you. If there's a little bit of interaction at high prices, but a lot of interaction at low prices, it's telling you that the market perceives higher prices as premium and lower prices as fair value. Okay. Let's move on. So, the interpretation and meaning of price action. What is price action? Well, very simply, it's the interaction between buyers and sellers. Right? We use price action. Why? Because it can show us patterns. Just like I showed you patterns on the profiling, you can see price action patterns. So I can pick up very early in the morning, and I'm going to show you this later, what a open drive looks like. So that broker at Goldman Sachs or JP Morgan, bang, comes, he executes. I can show you what that looks like on a ladder. Because why? Because he executes it the same way. So if you can learn that pattern very early on, you can take advantage of him. Then it shows us reoccurring events that have associated trading strategies to profit from. So things like auctions, right? Governments auction bonds all the time. Now, the way those auctions get filled into the market, into the secondary market or the future space, we can take advantage of that. Why? Because we can see the pattern on the ladder. Order flow. In other words, I can see when price is suddenly shifting. So if price has been muted all morning, trading 2A, 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 suddenly bang, buyer comes in and shows aggression, starts lifting bid after bid after bid, making prices go higher and higher, higher. I can pick up on that quite quickly. Right? Again, I can see passive versus aggressive interaction. So I can see when buyers and sellers are being aggressive or when they're being passive. I can trade order book macro events. So bang, ECB comes out, they hike, they do whatever, cut interest rates. I can interact and see the aggressiveness or see the interaction on the price ladder. Right? The market environment that governs certain order book patterns. So important, guys. You can pick up when a market is volatile or liquid just looking at the price ladder. Right? And that is why, guys, any professional trader has got a price ladder. Every single professional trader has got one. Why? Because, I'll tell you why. What are the benefits? Okay, guys, it makes sense. I'm not paying a spread. I'm hitting and executing at market, so the mathematics makes sense. I get best price execution, so I'm not paying 3 ticks on a spread. I'm not stopping out with this crazy, bid at 63, offer at, 68. I got direct market access. Right? I can pyramid, I can mash odds positions, I can leverage trade. You cannot do this with spreads, with CFDs. Right? You can only do these sorts of techniques of money management if you're trading at the market. Speed of execution. Bang. If the ECB announces something, I can't afford 20 seconds, I can't afford 10 seconds talking to my broker. Okay, I need the absolute fastest speed of execution. Why? Because in this day and age, it's all about speed. Right? Risk events, again, risk events, central banks, hurricanes, political elections. I mean, we've got Donald Trump versus Hillary Clinton coming up. Right? I've got speed, and I can see the intention of a market just looking at how price is responding. Right? I can see the true market response. So important, guys. Candles don't always reveal the true picture. What do I mean by that? Right? We had the retail sales out today. Go look at any bond market today, and retail sales will not tell you what really happened at higher prices. I will tell you what happened. There was a huge seller at higher prices of US bonds. Right? Not so obvious on a candle, not so obvious on a chart, not so obvious on a moving average, but very obvious on the price ladder. Why? Because I physically saw him. Don't tell anyone. I physically saw him selling the hell out of that market. That's how I know. Okay. Then price action is leading information. Right? It's telling us current, real information. Bang! Goldman Sachs comes in. He's buying the market at the open of the E-mini S&P 500 on the open. It's leading information. Why? Because I'll tell you what, if Goldman Sachs is buying 10,000 contracts, it's not going to take him 1 minute. It's going to take him an hour. Why? Because he wants to execute that at the best price for his client. So if I know that, I've got leading information, right? Charts are lagging. Once you've seen that candle green and start to buy, you've missed it. The game's gone. Everyone's ahead of you. I'm already ahead of you. Okay, then the order book is the purest form of the market. There's no purer form than how a buyer and seller interact. I buy, I sell. It's the purest form. That's why we use a price ladder as professional traders. Okay, now I'm going to just go through these very briefly. We've got a few different strategies. One, absorption reloading. It's very simple. A buyer comes into the market. He's going to keep buying higher and higher prices until he runs into a seller. When he runs into that seller, if that seller sells to him, he's going to keep reloading. Okay? He's going to keep loading the bid and taking whatever the seller's giving to him. That's reloading or absorption. Spoofing and layering, all right, where buyers come in, show the intention to buy, but in actual fact, they're just trying to bid up the market, fake up the market to get filled on an offer, and then reverse the market. Okay, bid over, offer over. What do I mean? It's someone comes in and someone is selling 83, say selling 83. Buyer goes, I'll take 83, I'll take 83. And once the seller's done, he goes, thank you, I'll take 84, I'll take 85 at the same time. Bid over. I go straight back at you, nice and aggressive. Okay, liquidity suction, broker execution. What do I mean by that? Well, when brokers come in, they've got to lift until what? Until they can find a seller, liquidity. So they keep buying until they find their liquidity. When they found their liquidity, they back off and they let the liquidity come to them. Right? Until that selling stops, then they resume and they execute the order. Front runs. If I see 1,000 lot in the market in the euro dollar and normally it only trades 65, 70 lots, bang, I'm in a front run. Why? Because someone's being a bad broker, someone's executing poorly. I'm going to get in front of him. I'm going to take advantage. And if that means I take the next price, that's fine. Because remember, the objective of trading is what? To make money. To be green, to be successful. Right? Flipping, just like spoofing and layering. Okay? Iceberging is where a price keeps reloading, but we can't see it. It's not so obvious. So in other words, instead of a buyer going, well, I'll just keep reloading, he keeps chunking up the order, right? Disguises it almost so that me and day traders cannot pick up on it so easily. All right, so those are some of the price action strategies. Let's get on to it. I'm going to show you an example now. I'm going to show you what the price action ladder looks like, and I'm going to show you the open drive. I'm going to show you what Goldman Sachs looks like when they come in on the Euro Stoxx 50 at the open. Now, this is an example that happened not too long ago. Okay, I'm going to go through this very briefly. What you're looking at is this market on the right here. Okay, as you can see, the market's open. So the cash has come in, and as we can see, the market is lively. It's engaging. Note, this is the volume trading on the right. Now, All I want to show you is how it looks, how it feels like when buyers step into the market. So note there, we started at 33s and the market's gone 4, 5, 6, and 7. So we've gone 5 price increments in a straight line. Bang, 5, 6, 7, so 9, 40, 41, 42, 43. Okay, this is all within 1 minute, guys. Goldman Sachs is in the market, they're buying up the market. Why? Because they deem it at a discount. They need to execute their order. Now note, we started at 34s and the market's run all the way up to 29.46. And what I said to you, a broker will continue to buy and be aggressive until he finds liquidity, a seller. So the minute we see a seller start entering, the market's going to develop two-way trade. Now note here, on the right we can see what's physically trading. What's physically trading? 3,000 lots, 728 lots. Okay, so we can see that there is a seller holding the market here, trying to sell to Mr. Goldman's broker. Right? And Mr. Goldman's broker says, well, I'm not having it, mate. This order's big. I've got to get going. I've really got to get this order done. And straight away what we're starting to see develop between 45 and 50 is a little bit of two-way interaction. So we started at 53 or 33s. We've moved to 51, sorry. Okay? And now we're starting to see a seller sell. Remember what I said to you. When the broker sees a seller, what does he do? He backs off. He goes from being aggressive to being passive. Now, let's see what happens when he continues to remain passive. So the market goes up to 51 and keeps backing off. Now note how we've spent. Remember what I said to you. We took 1 minute to drive 14, 15 prices. We've now spent 6 minutes over 6 prices. So note time, note speed, note the bid. It's going sideways. Okay, so the market backs off again off those 57s, backs off again, keeps backing off. So for 10 minutes, okay, we sat in a sideways trade. For 10 minutes, 11 minutes, note the selling, guys. Note all of this on the right here. Look at the volume going through. A lot of two-way interaction. In other words, when there is two-way trade, we are seeing fair value. Now that can change. Of course it can change. But at this point in time, this is being accepted as fair value. So again, I continue. This is 12 minutes later, 13 minutes later, 14, almost 16 minutes later. Note, we're still seeing this two-way trade. Okay? So what is our trade setup? Well, it's very simple, guys. When we have an open drive, when we see Goldman Sachs enter the market being that aggressive, we expect them to finish and follow through on the order. So what are we going to do? Well, you know what? We're going to jump in front of Goldman Sachs. Why? Because we know Goldman Sachs has got some more to do. So we jump in and we buy some falls and we look for some absorption. We look for that point where the seller stops selling to Goldman Sachs. Because the minute that seller stops selling to Goldman Sachs, what's Goldman Sachs going to do? Well, they're going to have to go back to the market. They're going to say, well, we've got to finish the order. Client wants them. They're going to go 5. They're going to go 6. They're going to go 7. They're going to go 8. They're going to go 9, 60, 61, etc., etc., etc. And the market's going to keep lifting, keep lifting, keep lifting, keep lifting, keep lifting until Goldman Sachs is finished with their order. Okay. Now, let's recap. It's very simple. Let's get back to this. Let's get back to this. Okay. So what we've seen there is what we call a simple open drive play. Okay. Now, all we're looking for is the drive. We wait for the first pullback. We wait for that buyer to keep reloading, absorbing the bid. The minute we see that, we buy it. What are we looking for? We're looking for the extension. The minute it extends, we get out. We take profit. We win. And we do this time and time and time again using a tool called price action. And there's numerous tools, guys, but this is one of the preferred tools of the professional market. That's the price ladder in action. Now, let's move on. I'm going to leave this till the end because I see we are moving on time. So if you do have any questions, save them for the end. So let's get cracking. So this is the key part, guys. Write this down. Take a picture. Take a snapshot. Just please keep this. So how do you create your own unique trade strategy using market profiling and price action? Using anything, guys. Please, when I say moving averages and stochastics and all these are lagging information, that does not mean they do not provide good information. I 100% use moving averages. I 100% have Bollinger Bands. Why? Because they provide me with a specific type of information. Okay? But that information for me is lagging. So I'm not going to trade off it. Rather, I will develop my trading strategies on forward-looking information. It's not to say you cannot be successful with lagging information. Of course you can. All right. So how do we develop a pattern? Well, the first thing is you've recognized the pattern using market profiling. What now? All right? Most go and trade it. Most of you go and trade it. I guarantee you see a pin bar on Google, someone shows you a pin bar, or you listen to a webinar like this, and I show you an open cash drive, and bang, you're putting that trade on tomorrow, and you think you know what you're doing. You don't. You're going to lose money. You might as well give me your money. I'll do better with it. Right? That's not what you do. What should you do? You reverse engineer. So first things first, you name the trade opportunity. Okay? Give it a name. Give it a funky name. Give it something cool. Something that, you know, that speaks words to you. Something that you'll never ever forget. Because bang, the minute that strategy comes, open drive. I know straight away, open drive. It's aggressive. It's Goldman Sachs. I get in front of Goldman Sachs. So I call it open drive. What are the characteristics? This is the important part. This is where most of you go wrong. And this is what I meant in the beginning by you do not think enough about your trades. You keep it too simple. You need to think. You need to create parameters. So what do I mean by that? When does it occur? When does an open drive occur? Okay? Well, it occurs at 8 a.m. So I'm only looking for this at 8 a.m. in the European, whether it's DAX, whether it's, you know, CAC, whether it's Eurostoxx 50, it doesn't matter. It occurs between the hours of 8 and 9 a.m. Simple. That's the only time I look for the setup. How does it occur? Well, very simply, a buyer comes in on the cash open, aggressively, note, aggressively moves price in one direction or the other. Right? He then looks for liquidity. Once he finds a liquidity, we get two-way trade. Once the two-way trade stops and the seller stops or the buyer stops providing their liquidity, the aggressor goes back to the market. Okay, straight away, guys, I've created a pattern in my head. How does it occur? I know how it occurs. I just showed it to you. Okay? Where does it occur? So in other words, in which part, where does a open drive occur? Does it open or does it work generally within the previous day's range? Does it work when you're breaking out of a key range? Okay, where does it occur? Trade location is so key to the success of certain trades. Does it occur on high or low volume? Straight away you should say open drive high volume. You should straight away have seen that high volume, not low volume. Why? Because we're seeing aggressive intent from a buyer. What's the price action like? Is it initiative? Is it responsive? Are buyers being aggressive or are they being passive, waiting for the market to come to them? What are your observations? Okay, what are your main observations? What time of day did it occur? Was there any correlations going on? Was there any fundamentals going on? Was I feeling comfortable sitting in my chair? What are your observations about this trade, guys? Every single little thing you observe is important. Everything. Okay? Early, late characteristics. In other words, define that trade setup. What does it look like in the early parts? Note, the open drive is aggressive in the early part. Okay? It then becomes a little docile, a little subdued in the middle part. And then the late part gets aggressive again. Straight away, I'm storyboarding. I'm creating a pattern story in my head. Okay? I'm thinking about my trade. Then, define your rules and parameters. It's very simple. Okay? Open drive, we recognize it. If we can get on that first open drive, awesome. But that's not the trade. The real beef is that first pullback. How do I execute? Bang. I look for that first little bit of absorption. The minute I see it, I enter at the market. Note, I didn't wait. I enter at the market. I use a tight stop. Why? Because I'm trading with momentum, not against it. Once my stop is in place, I'm looking for at least a retest of the previous extreme, if not an extension. I define exact rules, not ifs and buts and maybes, exact rules. Remember, guys, if I can take 5 increments or 5 prices out of the market and I leverage up with 100 contracts, I'm doing 5,000 euros. 5,000 euros, guys. Okay? That is the objective of what we do as traders. The objective is not buying the low of the euro and running it for 150 pips. Anyone that puts that on Twitter, it's all hocus pocus, guys. That's not the art of trading. It's not the art of where the markets are now. The art is what these algorithms are doing day in, day out, which is precision. It's decisive. It's exact, right? And they work on these these exact rules. Then I set the risk management in place, the money management, how many lots I'm going to use, how far I'm going to run, where am I going to stop at, what's the risk reward, all these sorts of things. How I'm going to execute. Am I waiting to get in a market passive or am I being aggressive? Okay. Then the most important thing, expectation analysis. What do I expect to see? Remember what I said to you in terms of time. Note how the time was aggressive at the beginning. When subdued, we spent 20 minutes in the middle and then got aggressive again. So straight away, when I see an open drive, I have an expectation of what I expect to see. Okay? The minute it steps away or deviates away from those expectations, 1, I note the observation and I write it in my strategy book. But 2, I also get the hell out, because if it's not doing what I expect it to do, I just get out. Take the scratch, take the loss, and move on. All right. Then the most important one, and none of you probably do this, emotional tracking. How do you feel with the risk, the stops, the time required for success, the overall process? Okay? Most people just focus on the process of the market. They never focus on the process of themselves. Okay? If you're someone that hates going offside, you've got to deal with that. If this is a trade that requires you to go 20, 30 ticks offside, deal with it, but deal with it before the trade. Because if you justify in your head, you say, bang, I'm getting in this trade, I'm going to go offside because that's the trade parameter. Awesome. You're never going to panic again. You're never going to get emotional. Why? Because you've already interpreted and understood what's expected. Track the performance. How often does it work? When does it not work? Right? Constantly upgrade the trade opportunity. Okay? When it starts working well, what made it work well? What's making it not work? Certain times of the year, certain things don't work. Okay? During the August summer months, momentum trades don't work. Shock horror, I can promise you, they don't work. Why? Because there's no one to trade. All the hedge funds on holiday, they're on the beach. Okay? Then apply to multiple markets. As simple as that, guys. One strategy, one execution, one process across multiple markets equals success. Note, you only need one strong trading edge to make very large sums of money. We have multiple strategies because our strategy can go cold at times. However, we only need to master one opportunity, one good trade to become financially successful at trading. Please, guys, if there's one thing you take away from tonight, trust me. I've worked at a firm, and they've had some incredibly successful traders. I mean, we're talking about guys that they make huge sums of money that I can't even begin to fathom to count. Okay, and they've made that because they stick to one thing, and they do that thing so damn well. Right? And that's how they're successful. Right? Let's move on. Now, 2 unique strategies. This is what I promised you all tonight. I'm going to go through this one, and then I'm going to finish off and show you a nice practical example combining the profiling with the price ladder. And hopefully you've learned something, gained something from this. So, 2 unique strategies. Number 1, an inside value breakout. Now, some of you will know this is an inside day breakout. Right? But what it is effectively is we've got a market that is each one of these depicts a day. So we've got a market that is doing a lot of overlapping. Okay, each one of these is a day. Imagine these 3 candles next to each other and a lot of sideways trade, up, down, up, down, up, down. And for 3 days, buyers and sellers are interacting with one another. Now note, remember we said when the market moves sideways on low volume, it's doing a bad job of facilitating trade. Now, the objective of the market is to facilitate trade. Therefore, by that definition, the market needs to move one way or the other, up or down. Now, it's that up or down that we have to be prepared for and we have to ensure we make money on, because we have to sit there for 3 days being bored out of our heads, waiting until it doesn't. Right? Now, bad traders lose money in these 3 days. Good traders make money on this day. Now, note the observations. Once we break out, okay, note the objectiveness. We can see straight away we have a low volume area. We've then got a little bit of acceptance. We've then got another low volume area. So the play is simple, guys. When you get a consolidated market, the breakout is very important. Okay, because why? What we expect to see on this breakout is initiative. So we want to see this low volume trade. So we want to see the market very quickly move away from where it's been accepting the last couple of days. Does that make sense? All right? If buyers and sellers have been interacting in this area for the last 3 days, the minute buyers say, well, we've had enough, we're fed up, we're going to take it higher, right? They want to quickly move away from this area, and that's why we get that low volume area. So straight away, one of the first characteristics of an inside day break or a value break is that low volume area. Right. We then get the acceptance. Note where the acceptance is. It's not within the previous day's ranges. It's above the previous day's range. So the market's saying, we did accept value there, now we accept some value there. Before we then get the initiative later on in the day by the buyers. And note where the buyers finish up on the high. So again, you go through it, you name it. You characterize the market. When does it occur? How did it occur? Where does it occur? High volume, low volume, price action, observations, early late characteristics, rules, money management, execution, expectations, emotion management. And we do this, guys, for every single trade. If you do not do this for every single trade, you're wasting your time. You're gambling. Like I said, rather give me the money, I'll gamble it. It'll be more fun. Right? So make sure, guys, whatever strategy you develop it in some template. This is just a basic idea for you. Right? It's something you can work with, something you can lean on to better your own trading. Alright, that's the first example. Let's go to the next example. Okay, just to show you again, that's the previous example. So here's the 3 days. I know a lot of you like the candles, so we can see the market consolidating for a long time. And note all of a sudden, note how the volume, guys. Note how the volume suddenly changes. Okay, you can see a much higher bars. See the moving average volume picks up quite aggressively as prices move higher. Remember what we said? When the market's moving higher or lower on higher volume, it's facilitating trade in a good way. Therefore, prices close nice and aggressively. Okay. Had that been on low volume, right, market's quite susceptible to a reversal. Okay, cool, let's move on. Now, our second strategy, and this is where we're going to finish tonight. All right? I'm going to show you the strategy. I'm going to show it to you on a ladder, like we did earlier, and then I want you to take these two strategies and develop them in your own way. Okay, what this is called is a tail profile reversal, or a failed consolidation. Now, what it looks like, and this is the daily chart I wanted to show you. Okay, it's that big red candle. What effectively has happened in the 2 days prior is we've got a market that is consolidating. We have an inside day, and the market then, so instead, like we saw in the previous example, we get the breakout to the upside, except this time it's failing the extension, and we actually get a tail reversal. So what does it look like? Well, it's very simple. We can see the market opens. Okay, it opens at the K, spends a bit of time inside the previous 2 days. It then extends on the cash, that's that imprint there, so the market cash opens, extends, comes back and closes inside, and then suddenly we can see the failure, or the failure then, the sellers start to engage and interact in an aggressive manner, leaving what? If we look at these M and N and P's and Q's, they start to leave very aggressive selling tails, or hidden tails. So what do I mean by that again? It means that where they open, they close on the extreme, and they open, they close on the extreme, they open, they close on the extreme. So they tail, so they very quickly move price back down the page, very quickly move it away from where they deem the market is trading at a premium. And note the objectiveness, the low volume area. So the market very quickly, the sellers very quickly tell us that all of these prices here are a premium for them. Therefore, by that token, they very quickly auction the market lower. And note the market then forms a high volume area below the previous 2 days. Okay, have you all got that, guys? So important. Again, we go through our template, we template our trade opportunity or our pattern that we recognize, and then we learn ways to execute, to get involved in this failed tail consolidation trade. Let's look what the price data looks like. Okay, so let's move on and have a look here. So what we're going to start off with, note, is I want you to watch the interaction here. So we can see the market comes up and comes up into this 45, 46, 47 here. So we can see right now the market's trading at the high of the day, and the market is going to go a little bit aggressive. So we can see 40s lift, 41s lift. So we can see a buyer showing his intention. Note we've taken out the previous high, and we can see a buyer lifting the market. Note the reload there. Okay, note the blip, guys. We call that a blip in the market, where it goes 40s straight up to 43s, 44s. In other words, that is someone stopping out. Okay, so we can see stops in the market again. Very important. Why? Because we can see aggressiveness. Now note, again, so we just blipped up 3 prices and we just blipped another 3, 4, 5 prices. Okay, so we can see very strong intent here, whether that's buyers buying the market or whether that's sellers stopping out. Okay, we can see this intention, and that's the important thing. Now note, the market went 48, 47, 46. Now remember, we've just seen buyers, so we've just seen an aggressive bout of buying in the market. Okay, so remember what we said, when we see this kind of aggressive buying, we want to see how the market facilitates that trade. Now, what I'm going to do is I'm going to move this on a little bit, and I'm going to show you. So we first get back to this point of 43s. Okay, now let's see what happens when the market has its first pullback. So the market comes back down, and note we trade down to 38. I want you to watch this because this is quite important. So remember what we said, when we have an interaction or when we have an initiation from buyers, that first pullback is quite pivotal. Why? Because we would expect to see buyers continue to initiate, continue to partake in the auction. Okay, so we can see the market comes back to these 38s, right? And what does it do? Straight away it bounces. It goes 38, 39, 40, 38, 39, 40. Again, the market backs off, comes back to that price called 38. Okay, and suddenly starts to auction below that point where buyers engage. So straight away, guys, in your expectation analysis, you'd be saying to yourself, well, hang on a sec. I've seen this aggressive buying in the market. It was an inside day break. All of a sudden, the buyers are no longer there. They tried to hold up 38s. They managed to get to 41s, and they got smacked straight back down. So straight away, what was support or where buyers entered the market, they're no longer there. Now, if buyers are no longer in the market doing what we expect them to do, it's telling us something. It's telling us that, well, actually, there's probably a large amount of sellers in the market. Okay? And that's when we flip. We don't flip before that. We're still a buyer until the point that those 38s get taken out. Now note, this is so crucial. This is the key little, pattern you see so often on the price ladder. What was support at 38, guess what that becomes? Resistance at 38. Okay, so where the buyers were holding the bid, now the sellers are holding it. And what do you think the sellers are going to do? What are they going to do to these buyers that have been buying? Okay, they're going to start smacking them straight back down. So we go 38, 37, 36, 35, 34, 30, and the market keeps auctioning lower and lower and lower. Now the bad traders are sitting there long, they're sitting there buying, they're sitting going, but the market went up, it was an inside day break, it should have done this and that and that. The smart traders, the good traders, were up when it traded 37, 36. The good traders flipped and reversed, they went short. Why? Because they saw what was happening. They remained objective. Why? Because they weren't trading on that candle pattern, which was a breakout. They weren't trading on the, caught up to the stochastics. They were trading on what they could physically see at that present time in the market. The market then goes down to 28. Note what we just saw. The market bounced off 28. So again, if the market's bouncing, it means that we're seeing a buyer come into the market. Note the market comes back to 28 a second time. What does it do? It bounces the second time of 28. So what are we seeing? A buyer. Now what do we think happens when we take our 28s? Okay. Not only does the market come back and test 28, not only does support turn resistance, but the market then starts to sell back down the page and all the way to the lows, blah, 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 blah. And if we look at it, I can fast forward this all day long. We went from high prices of 50s all the way down to 89s. Okay guys, that's 60 prices. That's big money. That's opportunity. Now, a lot of you say, yes, but that's not me. I'm not a day trader. I'm a swing trader. Well, heck, 60 ticks is a big swing trade. More importantly, guys, if I showed you, okay, what happened in the days after that, right, if I go back to this, and I showed you what happened in the days after, we can see very aggressively that the market continue to auction low. So don't tell me that's a day trader. It's not. That's a 2-point move, guys. 2 points is a swing trade. 2 points is a weak trade. It's an opportunity. And that's why we use profiling. That's why we use, price action. Okay. Let's finish off with this. As with any endeavor that involves complex associations, an understanding of the markets can only be perfected through extensive observation, study, hard work, and constant improvement. The world's top chess players are not merely intuitive, i.e. subjective, but have spent considerable time poring over patterns and potentialities, searching for that elusive advantage over the competition. That's what edge is, guys. It's extensive observation, study, hard work, and constant improvement. If you're not doing it, you're never going to catch up to me. Okay? And if you're not catching up to me, well, you're even further behind. Remember what I said to you. To be a part of that 5% of success, you have got to be different. You've got to be unique. You've got to do what 95% of people don't do. That is edge. Okay? So, heading towards the end of it, guys, axefutures.com. Go submit your email. Okay, if you want more information about profiling courses, about price action courses, okay, there you've got it. Email info@axefutures.com. Log on to the website. If you have any questions about, this seminar, anything burning questions that you really want to improve your trading, okay, send me an email. I can promise you I won't answer straight away, but I will answer. Right? If you don't follow me on Twitter, @trader_Brand, it's very simple. Follow me and post me a few questions. I love to interact on Twitter. It's a lot of fun. I enjoy it. Okay? Sometimes I get it wrong on Twitter. So what? Every single tweet I post is objective. Okay? That's the important thing. All right. Thank you very much, guys.
Okay. Thank you for the webinar. Let's, if you have any questions, go ahead and type them into the questions box, and we'll get going here. Let's see. Okay. Do you think it's possible or recommendable to do price ladder analysis in the fast-moving markets with small tick size like the FDAX?
Okay. I'll tell you, our most successful traders actually are scalpers of the thinner markets, and I'll tell you why. It's easier to see the orders coming into the thinner market, like the tax, like the NASDAQ, like the, oil used to be a lot thinner, but it's actually thickened up quite a lot. But, it's a lot easier to see price action in thinner markets because you can pick up on the real order flow. Whereas a thicker market, if you've got 2, 3, 4,000 lots, like in the US 10 years, right, it's not always as obvious and easy. Okay, for the thicker markets, what I tend to use is a delta footprint. Okay, a lot of you would have heard of these footprint charts, so I tend to use the footprint for thicker markets. For the thinner markets, I use mine. So 100% yes.
Okay. Then we had a second question. What is your take on volume charts? I use them on the FDAX, and I know I miss out the information if trades have occurred on the bid or ask, but I think I can detect the market's mood quite well with them aggressive moving two-sided value.
Okay, guys, volume is a fantastic tool, all right? There's a wonderful book by Anna Cooling called Volume Price Analysis. Brilliant, absolutely brilliant. Get it, read it, it's a great book. The important thing about volume is, remember, it's a tool. Okay, now a tool can be interpreted in many, many different ways. The important thing for you as a trader is to take that tool and define what high volume means to you in certain conditions. What do I mean? In other words, like in that example, if we had an inside day break and we saw high volume, what was the outcome of that over a number of trades? In other words, if I backtest that over the last 10 periods. If we saw that every time it broke out on high volume it extended, suddenly you have a very, very high probability setup. If you notice that every time it extended on low volume, it sort of was wishy-washy, it was a lot of two-way trade, didn't quite extend, sometimes failed, suddenly you're becoming a more intelligent, clued-up trader. So 100% volume is a vital, vital tool, but you have to know how to use it. It's not just a case of high volume equals prices go up or down, or low volume equals mean reversion. That's not good enough. That's gambling. That's subjective. You need exact strategy based on volume.
Okay, perfect. Are your exits manual or brackets?
Sorry, am I what? Manual?
Yeah, are your exits, I'm assuming stops as well, do you use manually stop or do you use bracket, OCOs, or?
Okay, yeah, it depends. Most often I'm a manual entry and exit because I like to be a little more aggressive. I don't mind hitting the market. But there are certain trades, if I'm basically going to nick an increment out of the market, take a price out of the market, or front run a very large order, then I'm going to use automated stops. So it all depends on the trade strategy. Right? What you need to ask yourself is, what's the best way for you to manage the risk? If you're someone who can't control your risk because you get emotional, well then your answer is simple, use automated stops. If you're someone that can manage yourself, then you use manual stops. If the trade requires you to use a manual stop, then use a manual stop. It's as simple as that. It's not a hard stop, soft stop case. It all depends on the strategy and yourself as a trader.
Okay. What do you do on very large volume fast instruments when reading order flow is near impossible?
Okay. As I said, because I trade multiple markets, guys, I miss a lot of things sometimes. So the first thing I do in the morning is I identify where I want to play, right? I do a stream quite often called Markets on the Move. And if the Bank of Japan is about to intervene in the yen and the yen is doing 2-3 point moves when it normally does one, I'm in the yen. I'm focusing on the yen. I'm focusing on the price action. Why? Because there's going to be price action opportunity. So when there is volume that is very quick and it happens in the currencies and all, I tend to then lean on my delta a lot more, or my footprint, or lean on the actual physical volume traded. So sometimes I won't always see it warranted. I'm not going to always see it. But then I rely on my tools, and I know what I'm looking for in those tools.
Okay. I was actually about to ask you this question myself, but Bill just asked, how many different trade patterns / plays do you typically use for the market?
Okay, I would say I've probably got a very exhaustive list. I'm unfortunately one of those traders that has got a very big playbook. And again, it probably is a bad thing. I'm going to tell you that right out front. It's a bad thing having too many plays because you're constantly looking for adjustments to all of them and you're never perfecting one. So for me, I'd say I might have about 20 unique different plays. I might have 30. I could probably show you 30 different strategies right now, but the only thing that matters is finding one or two or three. and perfecting those 1 or 2 or 3. That's the important thing. It's not about having multiple strategies. It's about having effective high probability strategies. So less is better in this instance. Rather have 1 or 2 strategies that you can apply across multiple markets, because that will make you successful down the line.
That's actually, I find that quite funny and personal to me, because when I first started trading, I had a system I called Revolver, and I had 3 different setups, and if one didn't work, I moved to the next one, down the line. So I kind of see that. Let's see. Not many more questions. If you have a question, please go ahead and ask it. If not, we'll wrap up here in a few minutes. There's a lot of comments. A lot of people appreciate and enjoy your passion and the information you're giving in the webinar. Lots of thank yous. And
awesome. So, thank you.
Do you provide training?
Okay, so I don't provide training myself. But like I said, if you want more information about courses and training, Axia Futures does provide it. I'm a mentor. In fact, sorry, I'm a trader first and foremost. I trade every single day, in and out, 12 hours a day, 13 hours a day if I have to. I do a little bit of mentoring on the side, and I help develop these courses. But yeah, if you want any more information, like I said, you can email myself, or you can email the info at Axia Futures, and they'll be able to provide you with more information about that.
Okay. Let's see. What charts are you using? Our platform as well.
Okay. Yeah, so predominantly TT. So what you've seen tonight is predominantly TT, trading technologies. Industry standard is what predominantly most professional traders use. What I would say, which is very exciting, particularly for the retail market, is that there's a huge fight going on amongst all the trading software providers, and they're all fighting over the retail market. So you guys are in a very good place right now. I mean, when I first started trading in 2011, the costs were £2,500 to £3,000 a month just to use the software. Now, I mean, with some of the brokerages, you can almost get the software for free. So you guys are very, very lucky. Trading technologies is what I use predominantly. And I mean, that includes both your charts, both your price ladder, like you saw, your profiles, all that.
Okay. Do you primarily just day trade?
Okay, so yeah, first and foremost, I'd say probably 90% of my trades are day trades. There are very specific strategies, like for instance, if I see on a monthly chart, like in the bonds, the US bonds at the moment, if I see we're breaking out of a 3-4 month consolidation pattern, by all means, then I'll sit on it for a couple of days if I have to. I'll sit on it until I achieve what I want to achieve. So there are times where I step up to the plate and hold on to something, but majority of my trades, I'm a day trader. That's where my edge is. And that's where I've defined most of my trading strategies. So the template I gave you tonight can be applied across any time frame. It's not time frame specific. So yeah, I'm predominantly a day trader.
Okay. This will be the last question. Do you use charts to take significant level information, monthly highs, where the market can reverse?
Okay. Very important question, and then this is, I think I want to leave you guys with this is,
yes.
Back in the day, levels used to work, what we call levels, support and resistance, where a market has traded before. But the important thing to understand, guys, is that a level created 3 months ago is only good in the instance of support where buyers are willing to engage at that point. Now, what do I mean by that? What most retail traders do is they'll go and buy there. So I like to call it blind buying. They're blind faith. They believe that the support will hold and they buy it. Now, that's not good enough. That used to be good enough, but it's not good enough anymore for a number of reasons, okay? One, you've got algorithms that'll, that know everyone's going to buy it there, so they take stops. Two, it's very obvious, so everyone is doing it. If everyone is doing it, it's easier to actually do the opposite and take advantage of everyone doing it. So what I'm leaning on is that it's very important to know where these key highs and lows or these support levels, these moving at. It's important to know them. But what is more important is to learn how to use those levels. So like I said to you, for instance, if there's a support level, I'm going to note that support level. But what I want to watch is at that level, are there sellers selling into that level? In other words, if we identify this as a really key support, but someone is sitting there selling and selling and selling, well, straight away, that's not my expectation. My expectation was to see no selling and only buying. So straight away, I'm using the same thing as you, which is a level. I'm seeing the same thing as you. I'm just applying forward-looking information, which is price action or profiling. So I'm remaining as objective as I can using the same information as you. And that's where the edge is it's me being able to be that 1 or 2 steps ahead of you to avoid losing if it goes wrong, but equally to get the best price if it goes right.
All right, perfect. Thank you for today's webinar. Great information, very practical, useful, and it looks like everyone really enjoyed it.
Thank you very much, and thank you everyone for joining. And like I said, feel free to tweet me, and good luck for the rest of the week, and good luck with the trading.
Yep. If you have any questions, comments, concerns, you can access Bran on Twitter or via his email address on the screen. Everyone have a good night.